Jeff Spolstra with Summit Mortgage, and this is Mortgage Points. In this video, I'm going to attempt to demystify the loan estimate form. What is a loan estimate form, or LE for short? The loan estimate form is a form, government designed, government required form that every mortgage lender is required to give you after you have completely filled out a mortgage loan application. The purpose of this form is so that you can compare loans from different lenders. The information is standardized. The government's designed it, says how it has to be filled out, how things have to be calculated, so that you can get loan estimate forms from 1, 2, 3, 4 lenders and be able to compare them effectively in order to choose your best loan option. So that's the purpose of it. Let's dive in and see what it looks like. So the loan estimate is a 3-page form. The first page here is shown. Let's focus here on kind of the top part. The page 1 is really about your loan and your monthly payment. So up here at the top, it's going to talk about, it's going to show you what your name should be there under applicants, the property that you're buying, the sales price, what your loan terms are. Is this for purchase or refinance? Are you getting a fixed rate or an ARM? Conventional FHA. Is your rate locked? This is important because if you have not locked in your interest rate, then it's going to say no, which means your interest rate is floating until you talk to your lender and say, hey, I want to get my interest rate locked in. And then it's going to be checked. You'll see yes checked. And there will be a time limit. There will be a date at which that lock expires. You can't lock for an infinite amount of time. They typically expire after, say, 35, 45, 50, 60 days, right? And it will tell you how long you have. It's also going to tell you that the other, just below that, that the other estimates on this form have an expiration date too. They're good up to a certain date, and you'll see that on the loan estimate. That's kind of all that stuff at the top, the broad overview. Loan terms, what's your loan amount? What's your true interest rate? What's the note rate? What's your monthly principal and interest payment on that loan going to be? That second column says, can this amount increase after closing? That's important because if it says no, then you know your loan amount can only go down. It can't go up. Like if you had a negative amortization loan, your interest rate isn't going to go up or down, and your monthly payment, your principal and interest part, isn't going to go up or down. So it's important to pay attention to that. If you're getting an adjustable rate mortgage, you will see those numbers probably change, or you'll see it might say yes beside it, for example, on the interest rate or the monthly payment instead of no. Other key things just below, payment penalty. Is there a penalty if you pay this loan off early? No. You want to be sure it doesn't say yes. Don't be surprised. Is there a balloon payment? Meaning, are you just servicing the interest for a while, or you're not fully paying for all the principal in the mortgage, and at the very end, there's going to be a lump sum that is due from you? Again, your best interest, that should say no. If it says yes, be sure you know why. The bottom part, let's go down to that. This is really about your payments, right? You'll see the principal and interest there again. If you're paying mortgage insurance, it'll be itemized. Estimated escrow. If you are having your property taxes and your homeowner's insurance, if you're paying that monthly with your principal and interest, that will show up there. So you're going to have to see an estimated total monthly payment. Now, below that, and this is where people get confused, is it's going to say estimated taxes, insurance, and assessments, right? Those numbers might not add up in terms of adding principal and interest plus the estimated total tax, insurance, and assessments. That may be bigger than what the estimated monthly payment shows. Well, you need to look to the right side there, where it says this estimate includes property taxes, homeowners insurance, homeowners association dues. It's very important to look at that column that says in escrow, yes, yes, no, right? So your monthly payment that you're going to see on your monthly bill from the lender, in this case, if this was your LE, you're going to see a portion on it for property taxes, for homeowners insurance, but you're going to be paying your HOA separately, right? So that the monthly payment as shown, or the projected payment as shown, is not including the HOA, but it is including taxes and insurance. And at the very bottom there is just a real quick look at your estimated closing costs and your estimated cash to close. It's not really important on this page because they're broken out on the page below, the second page. So let's take a look at that. All right, page 2 is all about closing costs, estimated closing costs, right? These are the what it's costing you to get the loan from the lender that's giving you this loan estimate. Let's focus on the left side. There's two categories of costs here. There's loan costs. Loan costs are things that you have to pay for to get the loan. Section A, origination charges. That's really what the lender, excuse me, is charging for you to get this loan. B, the B section, services you cannot shop for. These are things that you're going to have to pay for that need to be provided, but you don't have the opportunity to select who provides those. Things like the appraiser, credit reports, the flood certifications, etc., etc. The condo certs if you're buying a condo. Section C, services you can shop for. Now, these are typically title and escrow services. You do have the right to specify what title and escrow service you want used, so you can shop for these, but this is an estimate based upon the lender's choice or the seller's choice of the title and escrow company, but you can shop for these. Now, at the very bottom, total loan costs, A plus B plus C, right? Those are your loan origination and closing costs. Let's look at the other side of the page. Other costs. These are things that are either costs or are prepaid amounts. Section E, taxes and government fees. It costs money to record your transfer, the transfer of ownership to you. So there are recording fees and there's transfer fees. Prepaids. These are things like you're going to have to get your homeowner's insurance started. So your first homeowner's premium is a prepaid item. You're prepaying that 12 months right away up front. There's going to be some amount of interest to cover the partial month that your deal closes in. So you're going to have a little bit of prepaid interest. You might have to pay a month of homeowners association dues. Again, there's going to be certain things that you as the new owner coming in have got to pay for up front and ahead of time. Now, section G, escrow payments. If you are having your property taxes and your homeowner's insurance paid monthly with your principal and interest, well, that's called an escrow account. And those accounts need to be pre-funded a little bit depending on what time of year you're buying in, right? Depending on when property taxes are due or when your homeowner's insurance is due, stuff like that, right? You have to pre-fund some of that in there so that the money is available in that escrow account when your property taxes and your insurance comes due. So that's not really a cost because you would be paying that anyway. It's more getting that money in the bank, if you will, ahead of time, so it's there fully and ready to go when that cost comes up. And typically, escrow accounts are going to be your homeowner's insurance and some amount of anticipated property taxes. All right, there may be some other costs. You may have to pay a prorated HOA fee, or there may be other assorted costs related to buying real estate or selling real estate. Well, this is a buying trend that just don't fit under the loan costs and need to be broken out. So your total closing costs, right there, section J, total costs, your D column plus the other column, and there you go. That's going to be your total closing costs. All right, now there's a very important section here on this page at the bottom right corner, your calculated cash to close. This is an important thing to be looking at because it's going to give you an estimate of how much money do you need to have available, that do you need to put into escrow at the end of the day for your deal to close. So it's going to include your closing costs. It's going to include your down payment amount. It's going to include any funds that are coming from another source, like gift funds, any seller credits, any adjustments for other things. So this is a breakdown of what your total estimated cash to close is going to be. Very important number because this is what you got to have in the bank. This is what you got to have available to make this deal close. Very important thing to be looking at on that loan estimate. All right, let's go to page 3. Page 3 is really your shopping page if you get right down to it. Right, top of the page, a reiteration of who you're working with, who's giving you this loan, who your loan officer is, the contact information, their licensing information. The important part is the comparison section, because this is what you're going to use to compare with other lenders' LEs. So what you're going to see there is you're going to see a number that says in 5 years, you get this loan in 5 years, how much total will you have paid in principal, interest, mortgage insurance, and loan costs? There's going to be a number there. And there's also going to be a number that says in that 5 years, how much principal have you paid off? Well, that's a good number. It's a good thing to look at. The really important number is the annual percentage rate, or APR. Now, we've talked about APR before. APR is not an interest rate. It is a comparison number. APR is if we took all of the costs associated with your mortgage over the term of it, interest, your closing costs, everything, mortgage insurance, etc., etc. If we took all that, added it up, and treated it as if it was interest, all interest, what would that mean in terms of your effective interest rate, right? Remember, the page 1 says what your real interest rate is going to be. Your APR is what your if we roll all of your costs together and all your interest and treat it as just interest, what equivalent interest rate that would be. That's your shopping number, right? This is the number you use that if you get multiple loan estimate forms and they all have the same mortgage interest rate, they're probably not going to have the same APR. And the one that's got the lowest APR is telling you the loan that's costing you the least in terms of closing costs and over the lifetime of the loan. So that's your shopping number, right? That's what the government wants you to get. That's the whole purpose of this form, is to give you the APR and show you the numbers that are behind it. Now, if you want to really scare yourself and stay up at night, the total interest percentage, right? How much total interest you will pay over the life of the loan as a percentage of your loan amount. Yeah, okay, that'll scare you. Don't worry about it. Everybody does it. It's just there. All right. Other things to look at on this page. There's a blurb about appraisals. You can order an extra appraisal if you want. You have the right to get a copy of the appraisal report that the lender orders. Is your loan assumable? Can somebody later on take over your loan without having to refinance? Some could be an important thing to know. Construction loans, homeowners insurance, just a blurb that you have to have homeowners insurance and you have to maintain it. A brief statement on what it means, how late payments are dealt with. A statement about refinancing your loan. Now, don't panic, because you're going to see a sentence in there that says you may not be able to refinance this loan. That does not mean you can't refinance the loan ever. What it means is there may be a period of time where it financially isn't possible. You don't have enough equity in your home, or the interest rates are too high, or whatever. There may be a period of time where it's financially not possible, but that doesn't mean that your mortgage isn't refinanceable. Okay, very important distinction. The other, probably most important section here is servicing. This will tell you if the lender is going to keep your loan and if you're going to be making your mortgage payments to the lender that you got this LE from, or if they're going to sell it to somebody else and you will ultimately be making your payment to a different investor or a different lender. Good to know, so that you don't get surprised when you get a letter in the mail after you've completed your sale or completed your purchase that says, hey, look, you're going to start making your mortgage payments to ABC company instead of us. That's what this is meant to tell you up front, that you're going to get a letter like that, because the lender that is originating this loan for you doesn't intend to keep it and doesn't intend for you to keep making payments to them. Okay, there you have it. That is the loan estimate form in a nutshell. A lot of stuff there. If you have questions about it, please contact me. I'm happy to go over the numbers with you. But just be aware, you are required to get this form when you fill a complete application to a mortgage lender. It's your tool to shop from lender to lender to try and get the best deal. All right. Again, I'm Jeff Spolstra with Summit Mortgage, and this has been Mortgage Points.